Everybody, welcome back to another episode of the Study Wealth podcast. What I'd like to do here today is outline to you our top three themes for 2025 that we see here as of the end of 24 heading into 2025. Obviously, as market participants, we reserve the right and quite frankly have to have it necessary to be able to adjust our views as things change on an ongoing basis. Markets are always very dynamic. Nevertheless, our top three things here, looking into 2025, depending on when you watch this, I hope you are enjoying your last week or last few days of 24, or maybe you already here in 25 as you're watching this. Hopefully you had a good start to the new year. Now, what I'm going to walk you through here is really in no order of importance, but more so potentially in terms of causality. So our top three things here really are, number one, it's going to be stagflation. I'm going to show you a bunch of charts here. If you're watching this on YouTube, you'll see the charts. If you're watching it or listening on traditional podcast channels, I will be describing them to you here just as well. First of all, stagflation, that likely is going to be sort of the causation of the other two themes, meaning the other two themes are essentially going to be that we might see a step back in tech stocks, not every single tech stocks, but generally speaking. And thirdly, a volatility spike. And what I would like everyone to sort of think about here as we go through these 3 points here quickly to kind of outline our, again, broad view for 2025 is I want you to think about how are you currently positioned in your portfolio. Remember, I'm not giving any advice here. No investment advice is purely educational. But we do know empirically from sentiment studies, for example, various sentiment studies, that people are extremely confident. And that's always a good thing. It's good to be confident in their portfolio. But a lot of people are also potentially too confident. I always say, listen, everyone's bullish and everyone's happy in a bull market. And when things get choppier, things get much more difficult. People have reality checks, emotions come into play, and then things quickly can go from bad to worse to, really bad. So I also should say, before we look at this, I am not calling for stock market crashes. That is an outlier outlook to have. Look, stock market crashes can always happen. They can happen in bull markets, bear markets, and nothing markets. So that's not our call. We're not even really calling for a bear market, although that certainly could happen, but really calling for a different market. And 2024 has worked out very well for the bulls. Notoriously, the buy the dip, quote unquote, traders have once again been rewarded. However, we are now heading into a different year. And so I'm going to start sharing my screen here. And again, I will be talking about these charts here so everyone can understand them, even if you are not watching this and you're only listening to this. But what we are really seeing is an epic outperformance of tech stocks over the past 10 years. Now, tech investors will generally say, hey, tech stocks always outperform. And that's actually not really true. It always depends, of course, on the time horizon. But for example, if we look at a 20-year chart, we can see that the S&P has done very well, but the tech sector, as represented by the NASDAQ 100 QQQ ETF, and again, it's not a perfect representation of that, but it's actually done quite a bit worse than the S&P. Not bad. It's done very well. What has done poorly, relatively speaking, even more so, is energy and equally weighted stocks. So that's kind of the order in which things are happening, and we could start to see this reverse. We do think still a broadening of the market is possible. So an equal weighted position in the S&P or a hedged position in the S&P is something that we would advocate here more so than a purely S&P centric outlook positioning. So we think diversification is going to be very, very important. Now, what we really think is extremely likely here this year, in 2025, I should say, is an outlook, is a situation where the market starts to get more bifurcated as a result of what we call stagflation. Let me just quickly define what that means. Stagflation is essentially when you have above trend inflation and below trend growth. I actually thought that would already happen last year, so certainly mea culpa there. Although obviously, you know, markets are dynamic, so we were updating that view throughout the year last year as well to come in line with what we started to see unfold, particularly in the second half of the year. Nevertheless, as we head into this year, we are seeing some notable change. And if you think about, what this means, we've had since the election, since we have a new U.S. president, there's going to be a lot of headlines in 2025. There is going to be a lot of new economic policies, tariffs, and again, we think rising inflation. Now, if you look at some of the inflation forecasts out there, it is notable that more and more investors of the large houses are now more coming back to this view. And in fact, I'm currently now on this chart, on the charts here, showing a chart which shows how well we are tracking inflation versus how it played out in the 1970s. It is important for us to note, though, that we're not calling for, ultimately in the 70s, we had almost like 14% inflation at some point. It didn't last very long, but it did happen. We're not calling for that. Again, I think that's an outlier call, but we are calling for higher inflation for longer. So we've had, not even 2% inflation for a long time, 10, 15 years plus, 20 years actually, on average. We're calling for something closer to, 3 to 4, maybe even up to 5% in that range. That's a very different environment that I keep mentioning this, and it falls on deaf ears when the market still goes higher. But ultimately, within a 6 to 12 month time horizon, when people start to have drawdowns in their portfolios of anywhere from 10 to 30, 40, 50%, depending on how aggressively they're positioned, all in the same stocks, typically people start to wake up. And I'm trying to, at least, obviously, again, we're not giving any advice here, but through the lens of education, make sure people are thinking ahead as opposed to thinking linearly and saying, okay, whatever 2 stocks I played last year, they're going to work again next year. That is not necessarily true. In fact, it's quite unlikely that that's going to happen again going forward, although stocks can go up over time, but it's usually not the same names that are doing well. So that's why we're calling for a more diversified approach. And we're calling for an approach that focuses more on themes, sectors, industry groups, asset classes, rather than individual names so much. There's always a room for individual names. Obviously, from a trading perspective, we will want to be involved in some of that, but it's going to be much more difficult, we think, to make money here going forward for those people that are just looking to buy the dip blindly in the S&P. Now, I will say, and this is our major theme, it's going to be the year of the trader in 2025. What that means is we're going to have a lot more two-way action. So again, the people who have now basically bought dips in any stock or whatever on the 5-10%, and we're rewarded now, blissfully, we think that's going to stop working. So we're going to have to actually now turn our really put on an actual trader hat. I keep saying this: blindly buying the dip on something that goes down 5 or 10%, that's not trading. That's trend following, and it works until it doesn't work. And trend following is a wonderful strategy. It's our core strategy, but I think people who really think they traded over the past 5 to 10 years using that strategy or mistaken trading with trend following. Trading, I think, is coming back in 2025, and it's going to blow up a lot of people, but it's going to highly reward people who truly know what that means. Now, trading doesn't necessarily mean we have to intraday trade back and forth, the same stock 100 times. It's going to mean actually being a trader, understanding markets are dynamic. People look at things are going to get overbought, they're going to go back down. Things are going to get oversold, they're going to bounce, right? That's trading, and I think a lot of people haven't done that for the past 10 to 15 years, which is why I think for a lot of people, 2025 is going to be a very risky market, where I think a lot of people are going to be down 30, 50% in their portfolios unless they're careful of some of these dynamics that are going to happen. But I'm here about the opportunity set here. I'm not here to fear monger. That's not my thing. We want to look for the opportunity set. So if we understand that we might head into a stagflationary environment, which again basically means that we're going to have above trend inflation and below trend growth, we're going to have a different environment, and likely that environment will come with at least somewhat heightened volatility. Now, when I say somewhat heightened volatility, again, this is not a fear-mongering exercise. We've had extremely low volatility over the course of the past 5 to 10 years. We've had outbursts of volatility. Obviously, I'm just showing a chart of the VIX here. But on average, we're every time the VIX gets, back into sort of the 20s to 30s, it gets smacked right back down. And a lot of that has to do with passive inflows into the ETFs, robo advisors. A lot of these things I think are going to get tested in 2025. And we have to start thinking also differently about, yes, there's going to be some economic policy changes in the US, obviously, due to a new administration. That does not mean that the economy has to accelerate like crazy. I'm talking about the whole year 2025 now, not just a quarter or two. And I think that's where there's a lot of people that are very offsides right now. They think, yes, new policies, tape cutting, all that stuff that's should, all else being equal, be good for the economy. They're long stocks to the point where they can't buy anymore. And there's a difference between the economy and the stock market. And markets, I think that's one thing that people are going to have to realize, particularly the self-directed trader, investor. They consider themselves traders, as I said before. They really haven't been trading. They've been buying the dip and selling volatility. And I also think that selling volatility strategies could really, really start biting people who are using very aggressive strategies with very, very short-dated options. That is yet to be seen, but that might be something that could blow up if we see volatility, in let's say S&P terms, VIX settle somewhere in the mid to high 20s for a while, as opposed to the teens, right? That's a very different environment. So that's point number 2. And again, point number 3 is really this rampant outperformance we've seen of tech. And I believe in tech. I'm a big tech guy. I like investing in growth, but I think what a lot of people are missing right now, at least from the conversations we're having and then our analysis, is that the tech story is intact. However, it's the positioning where everyone's in the same few stocks that ultimately can cause big drawdowns in tech. And that's normal. As an investor, I want to see drawdowns, mean reversions in things like tech so I can buy things cheaper, whether that's on an individual stock level or it's on sort of a sector level, right? Either way, I want that so I have an opportunity to start buying again when things pull back. So those are our top 3 themes as we head into 2025. Again, depending on when you're watching this, we may already be in 2025, in which case I hope you had a great start to the new year. We are, by the way, seeing a lot more companies calling for higher inflation for longer, as I mentioned before. And a higher inflation for longer setup in a portfolio is a very different setup than an environment where inflation is lower. Basically, anything that benefits from inflation, from among other things, gold, hard assets, materials, value stocks, or cash heavy stocks, cash flow heavy stocks, will tend to do a lot better. And we think the energy sector will do very, very well. One sector, and again, we will update this throughout the year, that could also benefit, but it's just early to tell because we might get some headlines around it in the new U.S. administration, is healthcare. We think there's tremendous growth opportunities. It probably is the new growth sector, along with energy. However, we need to make sure we're in the right healthcare stock. So that's a very big and wide sector. There's biotech, there's a lot of innovation happening, but then you also have these healthcare insurance and providers and those kind of things. They potentially could see some more issues. So it's important to be investing in the proper segments of the market, subsegments of those kind of sectors and industry groups. So that's a quick and dirty sort of look into 2025. We will, of course, as I said, update you on this. Have a great start to the new year. Happy New Year. And we'll see you in the next episode of the Steady Wealth Podcast. Thank you for listening.